Thank you very much for the invitation to present this paper. Actually, the invitation was a great motivation to finish the work on the paper. So now it's a round piece of work. Otherwise, we may have been running the regressions for the next couple of months. I learned that it's good to open the discussion with a good quote and a good joke. So this is the quote. As Patrick, I think, is now doing some work in Merced, so this is very close to Yosemite National Park. So Hetch Hetchy, before the dam, was similar to Yosemite. And then they built the dam, which was highly contested. And the architecture, the chief engineer, said that the technical problems of the dam were very simple, but the political ones made it so complex. So my today's talk is to show that sometimes the complexity of the project comes from political variables, not necessarily from the technical ones that can be solved by engineers in a piece of paper or using advanced software. So this is the joke. What is a PPP in my understanding? It's like making fried eggs with bacon. Well, the hand cooperates, but the pig is committed in a long term with sharing profits, investments, and risks. If there is no long-term commitment, therefore we have a simple procurement. Otherwise, we have sunk cost, natural monopolies, public interest that comes into play, all sort of non-relational contracting issues, informational asymmetries, double-sided hold-up, and we can extend the list to all the papers we know and come back to that leads to renegotiations, the longer the contracts are. In the literature, I hope I haven't missed many of the people here present. I see your paper is also there. There is a space which hasn't been completed, and this is why we are trying to bridge. And this is from the political economy, the institutional framework into empirically testing what are the issues of relating to the private participation in infrastructure that are anchored in the institutional framework from an empirical point of view. We have a very simple model. I'm not as smart as Ronald, Eduardo, and Alex, so I will show a very simple toy model in where we have very basic assumptions are depicted here. We have a public agent and private investor that invest a certain amount of money. There is a predictable cash flow period that is a variable. It depends on the sector. There's a terminal value that is realized after that predictable period. And there are two discount rates. So one that is for the predictable period and then for the terminal value. In the terminal value period, the private sector only receives cash flows from the project, but the public sector can levy taxes and also can extract rents from the project. So even though the expected value of the terminal value may be the same, the standard deviation of that value is different, and that also drives why we may have two different discount rates. Just side note, the discount rate applied to long-term projects, public projects, is still an open question. The UK uses a single discount rate, but you can list as many economists, starting from Kenneth Arrow and Robin Lind, that say that you should use two different discount rates. And I'm working on this idea with Digen, and that maybe will be formalized in a paper somewhere soon. So after I will skip all the math. What we come with is a comparative statics where all these assumptions are internalized very simply, and we come to predictions. So the more efficient the private sector is, it's more probable that we'll have PPPs, which is totally natural. Also, it boils down to the productivity differential between the private and the public sector, to the number of years. I mean, this is the predictability of the cash flows, and it's sector dependent. A cash flow from a water company is more predictable than from a telecom, because the technologies arise quicker in technology sectors. And we have also a differential in the discount rate from the private and public sector. And this will also drive some implications, especially related to the terminal value, where all the political variables come into place. In the predictable period, even if there is high political risk, well, that risk, it's never going to happen in the next month. I mean, we're not going to expropriate, government is not going to expropriate a utility the next month after awarding. It will come after a certain period. So this is what we are trying to also model, that there is a predictable period where everything goes okay, and then all the political variables, the ones that we are trying to put under the carpet, that we don't want to discuss them. This is the bad things. Well, all those things are going to happen sometime in the future, in the what we call after the predictable period in the terminal value. So the predictions that we arise with are related to the rule of law, the quality of regulation, the freedom of corruption, from corruption, and the number of disputes. And these are because these are the variables that we have in our data set. So here it comes what I think is the major contribution of this paper. Maybe the results will be discussable, but the data set that I can share with is a compound of 4 sources of data. The most important data set is from the World Bank, and I have to mention also credit to my co-authors, Gonzalo, Gonzalo Raja, Fernanda Ruiz Núñez, who is not here, Jordan Smith, who worked for the World Bank. So they were thanks to them, this data was successfully compounded. So the major data comes from the World Bank, the PPIF data set that has private participation in infrastructure across, is a cross-country data set. We compound that with quality of governance standard database, which is assembled at the in Sweden, the Goethe University, not Goethe University, but in Sweden. Also with disputes at the country level, and as many economic variables as we could collect. And at the end, we have more than 2,500 observations from 80 countries, more than 100 variables for 30 years. Yeah, and depending on the specifications, the number of observations is going to be higher or lower if there are missing values. So the variables of interest for this study were the quality of government, and this is a mean of corruption, rule of law, and bureaucracy quality. Freedom from corruption is taken from the from Transparency International Corruption Perception Index. Then we have government effectiveness, and this measures the quality of public services. How competent are the civil servants, the government's commitment to policies. The rule of law includes the perceptions on incidents of crime. And also we have a variable for regulatory quality, which measures the incidence of market and friendly policies, like maybe in the extreme expropriation. So as for the identification strategy, to simplify this equation, we measure the level of investment with a moving average that depends on the sector. It's a sector-specific moving average and roughly is 1/3 of the depreciation time given by the World Bank. So if the depreciation time of water utility is 30 years, the time that is used for the moving average is 10 years for water. For electricity is 80 years, for telecoms is 4 years, and transportation, I think it's 10 years also. Then we have our variables of interest: freedom from corruption, governance effectiveness, rule of law, quality of regulations, and the number of court disputes. And many controls as population, growth, GDP, inflation, openness. This is the trade of the country, debt, the indebtedness of the country, and the access to finance. So to give you some summary statistics, the scoring of the variables of interest depends on who is collecting the data. So freedom from corruption, which was based on the perception index, the corruption perception index is from 0 to 100. But as you see, for instance, the rule of law, it's more of a mean, where the higher value here is 2, and the lowest is negative. So it depends on the variable, the scoring is not normalized. We just took as they were. I will show you just only one table, because all of the regressions that were run were with so many variables and so many of these models that they would not fit in a page. So here is just only the variables of interest of the preferred specification. And what we find is that all of our variables are significant at the general specification. In a second I will talk for the sectors. So as expected, more corruption, more freedom from corruption, so less corruption leads to higher investments. Also, government effectiveness was not significant, was not found significant, but the rule of law, yes. Although, interestingly, when we added the Gini coefficient, which measures how the disparity of income between the rich and the poor, so that effect of the rule of law disappears. That may be because these two variables are highly correlated. Quality of regulation is significant across all specifications, and also access to finance, although this is not a political variable, the access to finance. Interestingly, also the explanatory power of these variables is very high. For a panel analysis, having R-squares of 0.5 is a very nice result. So what we find is the political regime does not matter for private participation in infrastructure. If it is a democracy or a mixed presidential or even a dictatorship, it doesn't matter. So adding the type of political regime does not matter. What matters is what is inside the country in terms of corruption, for instance, or the quality of regulation. Large markets, of course, have more investments. Less inflation leads to higher investments, and the coefficients associated with 4 of our variables are economically and statistically significant. General results that we get. For instance, decreasing corruption by 10 points increases private participation in infrastructure by almost 7%. That means that if Serbia, which is more or less the size of South Africa, decreases or improves, decreases corruption to match the level of South Africa, they would increase private participation by almost 7%. Improving the rule of law by 1 standard deviation, that is to say, if Bhutan comes as in terms of rule of law as Jordan, which are more or less of the same size of the economy, that would lead to an increase in private participation in infrastructure by 4%. Also, improving the quality of regulation of Mexico as to become as Turkey would improve also investments by 3%. And having one less court case going to court increases investments by 4%. Now, we have also interesting results by sector. These were aggregated with only one variable that was sector specific, that is the timing. We also run regressions for water, telecom, energy, and transport independently. And what we find is that freedom from corruption is significant for all sectors but water. And here is a hypothesis that may be related to that. That in transportation, because it's very capital intense, it may be that is not about the level of corruption, but entering the market. But once you are in the market, you have to play by the rules of that market. That means that maybe some side payments are part of the package that investors are willing to pay. That you get some sort of protection in that sense. The rule of law is significant for the aggregate, but not for the sector specific. That may be related to the small sample of observations we have once we boil down by sector. But this is, I cannot rule out that is not significant for the specific sectors. The quality of regulation is statistically significant for all sectors but water. And that may be associated with some political issues. That let's recall that quality of regulation was how tight are the inflexibilities that I can get, how tight is the regulatory. And maybe that investors in water really want to have a very fixed rules. That I invest if regulations are going to be tight, because that means that because water is very politically sensitive, once the rules are very tight, they're not going to change farther on. So in a sense, more regulation in water may attract investors because that gives stability over time. Also, when we disaggregate by sectors, we see that disputes are not statistically significant for energy, for the energy sector. That may be also related to the fact that energy may be is more liquid. I mean, you can resell the plants or redeploy it into some other uses, not necessarily for the public use. For instance, for industry. As robustness checks, we run regressions with year dummies, and results were very consistent. We also expected to have, with countries with more experience, to have higher investments, private participation infrastructure, but that's not the case. So what may be happening here is not that the quantity, we measure experience by quantity of projects. So more projects is more experience. But here maybe is the quality. So maybe one project, but very well done, increases the quality of that experience, and that drives the private participation in infrastructure. Conclusions. Industry and political stability are key to private participation. Also, results are not are consistent for the whole sample and the aggregate of sectors. When disaggregated, we find differences depending on the sector, and this needs to be addressed. And as the bottom line, we need to address the upstream enable institutions, along with going down to how to apply what we have learned into specific projects. In the future, what we would like to do is also to run similar regressions for FDI to see if FDI follows the same pattern as private participation infrastructure. If there are some differences, we may have an interesting point here. And I will be more than happy to hear suggestions for ways of presenting this data in a more available way, and also ways of using. We have this incredible panel data that is assembled, but could be of the use of anybody of you interested in using it. To conclude, I also sympathize with the complexity of the projects, not only being the engineering ones, but also the political ones. So we have to understand more of the mechanics of institution and politics, because they do matter when we address the question of private participation infrastructure. Thank you.